All right. Now, I had some quick questions come in this week. I'll just use their names. I don't know if they're with us today, but from Ravi and Bill regarding rolling and managing covered call positions. With the recent market activity that we've seen, some investors in the past couple weeks, when the market started pulling down in September, might have rolled down covered calls. In other words, their stocks were falling, so they moved the calls down, and now the stocks are shooting back up. There's two different scenarios I want to look at. And I want to be cautious. We do have a webinar on this, but I want to be cautious about the concept of rolling for the sake of rolling. Now, let's take an example on JD.com. This is a stock that I'm in for a married put position following the radioactive trading techniques, but we're going to take a look at a covered call. Let's say a few days ago, earlier this week, we opened shares of JD.com at 82.69. And our plan was to sell weekly calls against this position to generate a 1 or 2% yield, 1 or 2% premium, maybe week by week by week. With the inflated volatility, of course, with the election and other things going on, we were able to sell the 13th of November 94 call, believe it or not, for 62 cents. So this gave us close to about a 1% yield against the position, a 1% downside protection. Now, the stock's currently trading at 92.56. It's moved up significantly the past few days. There's something else involved that we won't get into now. It's related to the Ant Industries or Ant.com that Jack Ma has over there in China. It dipped severely on Monday, and then it severely popped back up as well. Well, it's great to see things numerically. We're going to come back to this. Let's just take a look at the profit and loss chart. So what did I do? In this example, we bought stock at about 82.69. Okay, so we're right about here at the break even. We only collected 69 cents of premium, and that's to sort of just hedge week by week by week, hoping that the option expires worthless. We keep the premium. We can continue to do that if we want to hold the stock long term. Now, of course, as you can see, the stock has moved up to 92.49. Now, with this approach, using out-of-the-money weekly calls, what is my goal? My goal is to have that 62 cents or 65 cents of time value drastically decay in my favor. As long as the option, my 94 strike, stays out of the money over the next 7 days to next week's expiration on the 13th, then I'm sort of achieving the goals that I want. Now, there's a hesitation here. There's a fear in this case where you say, oh, well, I wanted to set it so that I closed the position if my option price doubled, or if my option price gained 50%, in other words, it went up to 90 cents. I've got to close that position and roll it because I'm losing on the call. Well, you are losing on the call. It's going to cost you more to buy back. But at the same time right now, this position is still doing what we want. The call is still out of the money. And as long as it doesn't breach 94, where I'm at risk of being assigned, I'm going to consider just leaving this open and letting that option decay. Now, I would have loved to sold it right now at 169, absolutely. But I'm not worried about a 2 times loss on this weekly trade I forced in to try to generate, close to a 1% yield or 0.8% yield, 62 cents on an $82.69 stock. I want that to decay in my favor, maybe to act as sort of a week-by-week dividend payment almost. But I'm not in the money yet. I'm not at threat of being assigned. If this stock stays below 94 between now and expiration, I can still just let this expire worthless. I keep the 62 cents. And yes, now, of course, I've got 11.9% gain on the stock. I can choose to liquidate. Or maybe now, let's say in a week, the stock's around 92. Maybe I can sell a 98 or 99 call, get another 62 cents. I'm not saying that this is the best approach for covered calls trading. Don't get me wrong. What I'm saying is that when you're trying to do out-of-the-money covered calls because you want to hold on to the stock and continue to generate premium to reduce the risk, it might not be the best idea to focus on the option premium itself. You really just want to focus on the price to your strike price here of the position. Oh, sorry about that. Because if I'm still out of the money, I still have a strong opportunity. Well, it might be lowering as a probability, but I have a strong opportunity of that call expiring worthless to what I wanted, so I keep that 62 cent premium. might not want to roll it prematurely, because what happens if I do roll the position now? If I buy it back at 169, I'm adding another dollar to my cost basis. What is that going to do? That's going to move my break even up. And if the stock reverses, I could see slightly larger losses. If it goes in the money and I don't want to be assigned because this is a core holding in my account, for example, then yes, once it gets up to maybe 94.50 or so, starts getting in the money, maybe I'll consider rolling the position now. But if my goal was to have this expire and I'm still out of the money, don't worry that it looks like you're losing 100 or 200% on the short call premium, because it's going from 62 cents to $1.69, because it's still out of the money. And it still could expire worthless in your favor. Don't roll for the sake of rolling. Don't roll because it looks like you're losing 170% on the option, because in order for that to happen, hey, I'm still at a 10% liquidation value right now, almost an 11% if I bought to close the call for that higher price and sold to close the stock. And if I hold it to, I'm sorry, folks. If I hold it to expiration, I could still make 12.8% even without being assigned. Well, that's, of course, if I sold to close the stock. So that's one kind of for Ravi, who was selling out of the money covered calls. And when he saw that the option premium doubled, he was actually still out of the money on the position, and he decided to roll it. It wasn't necessarily a bad idea. But if the option's still out of the money, what do I want to do? I want that time decay that I originally planned on to work in my favor. I want that to go to zero, because that was my game plan for this strategy and this approach. I don't want to feel nervous that my option bid price is more than doubled in this case, because I'm still making overall and the option is still out of the money to decay if I am using this approach. Another example for Bill, he was talking about Hologic's position, where he's in the stock at about 65.75. He's got about a $9 gain on the stock. And he's at the November 75 call right now. And the stock's at 75.07. So he's slightly in the money. And just like we saw with the JD.com position, let's say we originally got 110 for that Hologic's call. It's now doubled. It's trading at about 230. That's the buyback cost for the position. And now it's just slightly in the money. It's bouncing around that price. Of course, it did drop down drastically today, $1.61. I wouldn't call that drastic, but it did drop down to where its position is more manageable. So we take a look at the profit and loss chart. We're right at the money. We're slightly in the money this case and a little bit worried about rolling it because we don't want to get assigned. Well, as we saw, with only 14 days to go to November 20th expiration, the buyback cost in this call was $2.20. That's a lot of time premium for 14 days. It is unlikely that we're going to get assigned early, just being 5 cents in the money with the option still worth $2.20. By the way, most investors who buy a call option aren't interested in exercising it to own the stock. They're going to sell to close the call when they've reached their 100 or 80% profit or whatever their target goals are. But there has to be balance. So if a lot of investors sell to close their November 75 calls that they bought at some point for a profit, market maker doesn't want an imbalance, so investors might start getting assigned early to keep it sort of even. This is a worry. I'm slightly in the money right now, but not by too much. There's still a lot of time value in this option. It's about $2 worth, $2.15 of time value again for 14 days. That's a lot of time value. So I might not want to roll it at this time because I want to maybe hold it for a while and let some of that time decay work in my favor, because that's the goal. That's the true profit on a covered call position, while the call portion is the time decay working in your favor. If I have to buy it back now at $2.20, what's going to happen? My cost basis is going to go up by another $1.10. I took $1.10 in, I got to pay $2.20, $2.30 to buy it back. My cost basis is going to go up, which means, again, the break even is going to move up, and I might potentially risk more if the stock pulls back. So it might not be the best idea to roll it at this time, even though you're slightly in the money, just at the money, slightly in the money in that case. It might be better to wait, but if you are worried, of course, you may want to roll the position. In either case, this is where the portfolio really comes in handy, because I'm tracking any position in the portfolio. We can go to position actions and then position analysis. This gives us a breakdown of the current position I'm tracking in the portfolio. So we've got our original expected return if the stock was right at 75. Our current liquidation value, 12.3%. We're making 77% of what we expected to make on this covered call. And of course, if we hold it to expiration, we do get assigned right at 75, we'll make the 16%. But then down below, you'll see the rollout opportunities, where if we buy to close, it moved up on us. I buy to close the November 75 call now at 243, roughly about the midpoint price. I could sell to open the December calls, the December 80 calls for new premium, or showed our new net credit on the position, and most importantly, our new downside protection or percent return if assigned, if the stock's trading above that price. So yeah, if I currently at a 16% return, I doubt I'd roll to December 75 only to increase about 2% for an additional 30 days. But if you wanted to roll for a higher net credit, that's not a bad trade-off. Going up to a 23% potential return if you're still bullish on the stock, or if you still want to stay out of the money and have it expire worthless, you're still keeping a credit. And if it does go up again, your new return's at 23%. Now, it's great to see things numerically, but as you're looking and evaluating the rollout opportunities, we go to simulate trade. And now you've got a side-by-side comparison. I'm sorry, I rolled down a little too far. Your before and after picture. My current position over here on the left in red, and what my new position would look like over here in blue. And we see that on the profit and loss chart here. What is my increase? What is my different in cost basis to break even and more? So we can analyze that too. And if we decide to make that adjustment, we can do it right here from the simulate trade feature. Now, I just wanted to bring that up with the market conditions being as they were, a couple conversations that I had today. Depending on your outlook and the structure that you're using for covered calls trading, it might not be the best idea to use the option premium going up double as a means to roll the position. Because if I'm still out of the money, in the case of trying to sell week by week by week, I still might meet my goals and have that call expire worthless and achieve, again, that 0.8% or so that I was looking for against my cost basis on the underlying security. And in that case, of course, in order for this to happen, the stock had to appreciate much more than I probably anticipated in that 3 or 4 day period. So I'm still looking really good on this trade. But I might not need to roll it now and panic just because the options bid price is doubled, because it's still out of the money. It hasn't gone above my strike price yet, to where I may have to worry about being assigned early on the position. Similar to the whole Logix position, it's not a bad idea to roll if I want to protect it and I don't want to risk early assignment, but the time value is very high here. We might just want to wait to see what happens the next day or so going into next week. See if we get some of that time value decay back in our favor, what the stock does, then evaluate a roll at that time. But the target shouldn't be just the option bid price double, unless you're slightly in the money and you're worried about holding the position long term. Now, again, underneath that covered call tab here on Power Options, you can see our full discussion on the covered call approach, Ernie's course on covered calls, aggressive strategy for the conservative investor. You can also locate that, of course, in the Power Options store under the products page as well.